We did just get an update from the bank stress test, and the Fed says that all 34 banks that they examined did indeed pass this year's stress test. But what they were actually tested on is a really bad economic outlook. So this is a bullish thing, in my personal opinion, for the overall market, saying that the banks are in a very good situation overall to withstand a very bad economic outlook. But at the same time, this could indeed cause margin calls, because what this essentially is it is testing the banks to see if they can manage to take massive economic beatings and still keep that minimum 4.5% cash reserve for their equity balances, right? For the assets under management, normal banks have to keep 4.5% of that total amount in reserves to cover losses. Well, what happens with these stress tests is it essentially says that this bank, you got to put more money up in your reserves because you have a greater likelihood of seeing larger losses. Some banks might have to keep less, but overall this can induce some degree of margin calls, and that's what I want to talk about, exactly what happened with this year's stress test, or at least this stress test in general. So let's get into it. So this says, what is new with this year's bank stress test in 2022? It says the U.S. Federal Reserve is due to release the results of its annual bank health check on Thursday. Under the stress test exercise, the Fed's test banks' balance sheets against a hypothetical severe economic downturn, the elements of which change annually. Now it says, why does the Fed stress test banks? The Fed established the test following the 2007 through 2009 financial crisis as a tool to ensure banks could withstand a similar shock in the future. The test formally began in 2011, and large lenders initially struggled to earn passing grades. Citigroup, Bank of America Corp, JP Morgan Chase & Co., and Goldman Sachs, for an example, had to adjust their capital plans to address the Fed's concerns. Deutsche Bank's U.S. subsidiary failed in 2015, 2016, and 2018 on the qualitative aspect of the test, which assessed banks' operational controls. So it says how banks are assessed now. And this is where kind of the margin call situation or aspect of this comes into effect. So it says the test assesses whether banks would stay above the required 4.5% minimum capital ratio during the hypothetical downturn. Banks that perform well typically stay well above that. How well a bank performs on the test also dictates the size of its stress capital buffer, an additional layer of capital introduced in 2020, which sits on top of the 4.5% minimum. That extra cushion is determined by each bank's hypothetical losses. The larger the loss, the larger the buffer. And unfortunately, we don't get the actual numbers. I believe for a couple of weeks, I am not seeing any numbers coming out. I heard a couple months. I don't think it'll take a couple of months to see those actual numbers, what banks have to put up, what percentage of additional capital, aka which banks did better than other banks. And that is really where you could see some margin calls. If something like JP Morgan or Goldman Sachs or someone else had to put up, let's say, an additional 5 to 10% of their assets under management in reserves, they might have to call back on some of their loans or not give out as many loans, which could turn into margin calls specifically for the riskiest assets that the banks own and have exposure to, which is probably in hedge funds, probably in equity markets in general. After all, the total margin debt sitting at about $750 billion is a substantial amount of debt that is on banks' balance sheets. Now, it says, basically, this year is a tougher test. The Fed changes the scenarios each year. They take months to devise, which means they risk becoming outdated. In 2020, for example, the real economic crash caused by the COVID-19 pandemic was by many measures more severe than the Fed scenario that year. The Fed devised this year's scenario before Russia's invasion of Ukraine and the current hyperinflationary outlook. So at the same time, it's not factoring in the very high inflation that we have been seeing and the war in Ukraine. Goes on to say, still, the 2022 test is expected to be more difficult than last year because the actual economic baseline is healthier. That means spikes in unemployment and drops in the size of the economy under the test are felt more acutely. For an example, the 2021 stress test envisioned a 4 percentage point jump in unemployment under a severely adverse scenario. In 2022, that increase is 5.75 percentage points, thanks largely to rising employment over the past year. As a result, analysts expect banks will be told to set aside slightly more capital than in 2021 to account for expected growth in modeled losses. And what we remember from the stress test in 2021 was essentially something like JP Morgan had to put up 7% additional capital on top of 4.5%, the already baseline minimum. Other banks that are more risky had to put up well over 10%. And what this is basically saying is that's kind of what we can expect this time around, but even to a larger degree. Now, it says all banks are tested. In 2022, all 34 U.S. banks monitored by the Fed with over $100 billion in assets will undergo the stress test, compared with 23 lenders last year. That's because the Fed adopted a new standard in 2020 that stipulated that banks with less than $250 billion in assets only have to take the test every other year. That means that large regional banks like Ally Financial and Fifth Third Bancorp are up again after a year off. That is the end of this article, but let's look at the article that just came out 2 minutes after these stress test results were actually released at 4:30 p.m. It says, quote, Fed says banks could withstand 10% unemployment, 55% stock price drop in annual stress test. The Fed sees banks will have enough capital to keep lending even if unemployment rises to 10% under a hypothetical scenario. And it goes on to say the Federal Reserve Board on Thursday projected the potential for a rockier road ahead for banks than it did a year ago, but said the 33 financial institutions it reviewed passed its annual stress test of capital reserves. The Fed estimated $612 billion in potential losses for banks in its most severe economic scenario, and said even if this comes to pass, banks would still be healthy enough to provide loans to homes and businesses to keep the economy afloat. That's a $50 billion more severe loss projection than a year ago by the largest banks. Quote, this year's hypothetical scenario is tougher than the 2021 test by design and includes a severe global recession, the Fed said in a statement. The Fed's model included a 5.75% increase in unemployment to 10% and a 40% decline in commercial real estate prices and a 55% drop in stock prices. Under these conditions, the aggregate common equity capital ratio, a cushion against losses, would fall by 2.7% to a minimum of 9.7%, which is twice the minimum requirement in 2021. The projected drop in aggregate common equity capital ratio was 2.4%. So it is indeed saying that overall but banks have to put up more capital now because there could be an even larger decline, and that's what the stress test showed, and that could mean some margin calls for some specific hedge funds, especially a lot of guys that have billions of dollars of the bank's money. They don't just float around billions of dollars all too often without securing those that collateral or securing that loan, essentially. It says, after the test results, banks will be cleared to announce dividends and stock buybacks starting Monday after the market closes. Federal Reserve officials emphasized that the economic slowdown in the stress test is not a projection of how it expects the economy will actually perform, but rather a hypothetical to measure the strength of banks. The stress test also assumed more than $450 billion in loan losses and $100 billion in trading and counterparty losses. The banking system also has limited exposure to losses in crypto markets and is expected to remain resilient despite upheaval in that sector, Fed officials said. The banking system started out the year with a 12.4% aggregate common equity capital ratio. It has dropped slightly in 2022, but remains well above historical levels such as 5% in 2009 and about 10% in 2012, according to Fed data. The stress tests cover the largest U.S. banks, including JP Morgan Chase & Co., Goldman Sachs Group, American Express, Morgan Stanley, Wells Fargo, Bank of America, and Citigroup, as well as regional lenders. Ahead of the results, bank stocks are mostly lower as Fed Chairman Jerome Powell testified for a second day before Congress and reiterated his commitment to fight inflation. It says the stress test measure banks' balance sheets against capital requirements for banks as an indicator of their strength in a potential economic downturn. The results then shape how much capital banks return to shareholders in the form of buybacks and dividends. It goes on to talk about politicals, which I really don't want to get into right here, but this is basically saying, hey, you know, we're going to have to see a lot more capital put up for banks overall. We don't know specific banks yet that will have to put up more or less. I don't know if you guys remember those videos that came out in 2021, but we went over this quite extensively, and you did see some very weird moves in the overall stock market around that time, and that's something I want to watch out for this time around, specifically given where, you know, the margin debt is not really coming down all too much, and the Nasdaq being down 30% already. If hedge funds, I keep saying hedge funds, if banks have to put up a decent amount of capital here, if we're talking about, you know, tens of billions of dollars potentially in additional reserves that they have to put up for 2022, then you could definitely see some of those margin calls. But by and large, banks did pass, so I think that should be initially bullish. You are dropping here in after hours down about 0.41%, so we'll see how that all does shake out. But yeah, I think it's better than not. If the banks were to fail in a big way, then that would have been a really bad sign. That's the difference between, like I've said many times, a recession and a depression. So thank you guys for watching. Hit the like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. Come join us on the live stream in between 10 and 11 p.m. Eastern Standard Time. Thank you guys for joining. If you guys want access to all of my trades in real time, link down below in the pinned comment or in the description of this video. You guys enjoy the rest of your day, and I will see you in the next one.